What's up, guys? It's John again. Just want to share another thing that I found in The Intelligent Investor. And this little snippet is in the commentary of Chapter 1 again. And it's Jason Zweig talking about what Benjamin Graham talks about in his first chapter. This little segment is called Unsafe at High Speeds, and it compares investing versus speculation and how many people invest a certain way during, say, for example, bull runs, and they will say, hey, this method works, therefore this is the way I'm going to invest, and I'm just going to keep going that way because I'm getting returns without any regard to what an actual investment is in regards to how Ben Graham defines it. So let's hop into it. So the section, Unsafe at High Speeds. Confusing speculation with investment, Graham warns, is always a mistake. In the 1990s, that confusion led to mass destruction. Almost everyone, it seems, ran out of patience at once, and America became the speculation nation, populated with traders who went shooting from stock to stock like grasshoppers whizzing around in an August hayfield. People began believing that the test of an investment technique was simply whether it worked. If they beat the market over any period, no matter how dangerous or dumb their tactics, people boasted that they were right. But the intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be sustainably and reliably right. The techniques that became so trendy in the 1990s, dot-com era, day trading, ignoring diversification, flipping hot mutual funds, following stock-picking systems, seemed to work. But they had no chance of prevailing in the long run because they failed to meet all three of Graham's criteria for investing. And then here's this little section just kind of explaining and giving an analogy to investing in a way just because it quote unquote works and you're earning returns versus it being a reliable long-term investment. So to see why temporarily high returns don't prove anything, imagine that two places are 130 miles apart. If I observe the 65 mile per hour speed limit, I can drive that distance in 2 hours. But if I drive 130 miles per hour, I can get there in 1 hour. If I try this and survive, am I right? Should you be tempted to try it too because you hear me bragging that it worked? Flashy gimmicks for beating the market are much the same. In short streaks, so long as your luck holds out, they work. Over time, they will get you killed. So in this little section, they're talking about the 1990s and how now, while I'll admit that I wasn't there during that time, although I was born in 98, but I didn't see this whole situation pan out. As I understand it, there were a lot of crazy things happening, and a lot of different gimmicks, as they called them, were working. People were day trading, people were buying the next hot thing, and then just flipping it and basically using the greater fool theory, which I explained in the previous live, or maybe a couple days ago. But talking about how people would buy something with the sense of wanting to sell it to the next greater fool, whoever will pay more money to them for this item or this stock. So they're talking about how in the 90s, people are doing all these things, and if they seem to work over the short term, they're like, hey, heck yeah, this works, I'm right, stock went up means I'm right. At least that's how they saw it. And then eventually they get cremated in the market. And things just don't work out for them after that. So I see that as kind of a similar scenario to what we had in the 2020s and 2021 era, I guess you could say. Something that I remember is there were a lot of SPACs coming out, special purpose acquisition companies, which were blank check investments, and basically an individual or really an institutional investor would go out and say, hey, I'm going to go find a company. I don't know what it is yet, but give me your money and we will find a private company and bring it public. And everyone was just so quick to throw money at all these different investments, and really these were just pure speculations, although sometimes they're investments based off of just the quality of the management and the investor. But there was just so much money being thrown around, and so many companies were going public, and it seemed to be the case that investor sentiment was just, hey, if you invest in the market, you're going to make money regardless, so people are throwing money around. And that is something that could potentially work in the short term. Over the long term, you will get cremated. And if you've seen many of these companies that have gone public via SPAC, they have just been demolished. And many of them are 90% plus declines from when they went public. So, ouch. Anyway, I just want to share that little section in The Intelligent Investor. Hope you got a little value. And as you can see, I've got a boatload of other tabs, and I plan to be doing a little more of this in the future. So make sure to stick around for more. See you guys. Thanks.